Hey there, welcome to the video. I'm Scott Welsh, and we get together every week to talk about how to beat the market. And I've got quite a passionate subject today about market timing, and we'll get right into it. Three things today. We're going to talk about the quote, "You can't time the market. You can't time the market. You can't time the market." Oprah giving out cars, remember? Anyway, there is a quote that I just heard with my own ears about a week ago, and I want to talk about it today. So that's number one. We're going to talk about that quote. And then number two thing we're going to cover today is, really? You can't time the market? Really? And number three is, does trading after a gap count as timing the market? And if it does, then, all right, we'll just get right into it. First, a disclaimer, please do not risk anything that you cannot afford to lose. And all these results are hypothetical. They're not taken out of live accounts that get you information and entertainment, but they are hypothetical numbers. Got it? Moving on. Happy Wednesday, of course. We moved from Thursday to Wednesday. You know this by now. Let me know if that's working for you. If it's not working for you, I want to get you the information the way you want to get it. Okay. Let's talk about point number one, and that is timing the market is impossible. As I mentioned, I love listening to podcasts, watching videos, reading books. And just a few days ago, I listened to a podcast from a very, very famous person, almost a billionaire, who wrote a book on trading, who talked to other billionaires, and he said that timing the market is impossible. This was a famous person talking about other famous people and what they know as an absolute certainty. Now, how do they know it's a certainty that you can't time the market? Well, they cited two independent studies that ran for over 20 years of data, and that proves that market timing is impossible. Well, how did they do that? Well, here's the fact that they came up with. Two independent studies. See, they're independent. They didn't corroborate with each other. Do you know what happens if you miss the best 10 trading days in the past 20 years? So if you decide, oh, I'm not going to be in the market, and it happens to go up crazy, if you miss 10 of those by trying to time the market, you know what happens? Your return is cut in half. Moral of the story: we never know when the market will go up, so don't even try. It's impossible. Do nothing. And he gave the famous quote by the famous trader Jack Bogle, the champion of index funds, the father of index funds, who said famously, don't do anything, just stand there. As opposed to don't just stand there, do something. But for him, it's like, you're stupid, you'll never figure it out, timing is impossible, so do nothing. Be a moron. Well, it doesn't make you a moron if you do nothing, I suppose. But I'm angry, as you know. Be a zombie and never try to do anything. Okay? Really? Really, Jack Bogle? Really, experts all over the world? Okay, let's talk about it. What does timing the market really mean? I'm getting the impression from listening and reading this stuff that they think, these experts think, that the general public is just sitting around in our underwear guessing the market will go up. Oh, I saw that TV program, so I think it'll go up. Or, oh, I went to the mall and I think it's going to go down. I think they think we're just walking around willy-nilly trying to, quote-unquote, time the market. And of course, that's probably not a great strategy. And by doing that on emotion and hunches and whatever, you might miss those 10 best trading days, and that would be not good. I get it. So instead of going around and trading on whim, just stay the course. Okay, valid point. But is that really the only way to time it? I mean, are those the two extremes? Mall shopping and doing nothing? Or is timing the market simply waiting for a specific thing that makes logical sense, waiting for that to happen, and then trading exactly at that time? Saying, things happen after this happens. I'm going to get in now. I mean, is that timing the market? Because if that's true, and being specific on when I enter and entering on purpose exactly after that anomaly, and it works, then you can time the market, right? Okay. Well, let's talk about gaps. As you know, if you receive the newsletter, we're talking about gap trading this week. We're going to talk about systems that trade gaps. I'm going to give some numbers and so forth. What about gaps? Gaps signify, without question, extreme emotion. Otherwise, there would be no gap, right? So many orders come in after the close or in post-market or pre-market in the stock market. So many orders come in, the price, boom, shoots up, right? It doesn't just enter the open where it closed yesterday in a nice, smooth, orderly fashion. Something crazy has happened. An extraordinary amount of orders have come in and price gaps. That is it. That's the only definition. If orders don't come in, it doesn't gap, right? So, gaps are an interesting time to try to trade because it's interesting because for sure something is going on. Now, is that a good time or a bad time? We'll find out, but it's definitely something, okay? But speaking of timing, what if we took this something, gap trading, and only based our trading decisions upon when gaps occur? If I only traded, if I'm not just in the market forever, if I only traded on gaps, that's timing, right? 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 I'm not going to the mall. I'm specifically researching an anomaly that makes sense and then trading on it. I'm going to get in just in time after this anomaly. So if that works, then what conclusion can we draw? All right. Let's talk about a gap system and how we would enter and what that would bring us. Okay, we're going to look at the SPY, the ETF equivalent of the S&P 500, and we're going to do a momentum gap trade. Now, what is momentum? Momentum means a gap up. Momentum is rising, and we're going to go with it. Momentum is crazy up. We're going to go up. That is a momentum gap trade. We'll talk about a different type of gap trade in a second. So if it gaps up, we want to get in at that moment and time the market that way. Okay, what are the rules for entry? Well, the current low, okay, we're looking at the charts right now, or maybe at the end of a day. The current low of this bar, the most recent bar, the current low is higher than the previous day's high, right? So not only did it gap up, but the low stayed higher than yesterday's high. So not only do we have the emotion of the actual gap, but it never dropped down to yesterday's high. There is clearly upward emotion going on. So if we get a gap up and the low is higher than the previous day's high, that's good enough for us. We enter at the open of the next bar and we are in. I'll talk about the countertrend gap, the fade gap, whatever you want to call it, in a little bit. Okay? And here's the picture on the screen. Can you see it? All right. I circled it here. Please let me know if it's not clear. Okay. This would be the current bar. Get the cursor off, you idiot. Do you see in that how the low is higher than the previous day's high by a mile? So it gapped and it didn't drop down very much. The low is higher than the previous day's high. That's it. Gap up, the low is higher than the high. If this dropped down below the high, then nope, we're not trading it. All right, so if that happens, gap lower than the high, we're in at the open of the next bar, and that is your momentum gap entry. And then we'll hold it for a certain period of time. Okay, and you can see that this gap and drop and in at the open. Oh, it came back a little bit, but on the whole, by and large, this is a profitable trade. We timed the market here, went immediately our way. We had some pullback, and then it went our way pretty substantially. Got it? It's pretty darn simple, okay? Now, we're going to talk about the countertrend gap. It is the opposite, and we are going to give you stats on the countertrend gap in the emails this week. First email will be on momentum gap, and then we're going to talk about countertrend gap. So get on the email list to get that data for countertrend. I don't have the information here, but I'll show you the entry. Price gaps low. The high is lower than the low. So it gapped and it stayed down below. You enter at the open of the next bar. So this is entering when people are fearful, whereas the other one is entering when people are crazy happy. I wonder which one works better. Get on the email list to find out. That's a good tease. All right. This is the performance report for the momentum gap only. All right. You got your $9,000 profit, and you got your drawdown, which is less than buy and hold. It's a decent little strategy, decent profit factor. You can see all of the different metrics there, and this is over 20 years, which is very similar to that study. Percent profitable 65% of the time, right? Remember, to get all the details, get on the email list. I just want to show you the stats and the entry. Okay, there you go. So, bottom line is, of course, I give all the details on the email list. Get on it. It's free. That's great. Okay, let's sum it up now. We saw some profit there. Yes? Okay. If there's profit and we got in on a timing mechanism, what does that mean? That timing the market is profitable and it's possible. Trading the momentum gaps this way, as long as we throw on a timed exit, which of course you get the details in the newsletter. Trading momentum gaps on timing with a timed exit is just as good in this particular testing period as buying and holding. It makes a little less, but it also has a little less drawdown, right? Timing worked just fine, and it did not make it go down half or worse, as the experts said. They cited a study saying if you time the market, you won't make the returns. In fact, it could go down by half, or it could go down even worse. Well, we timed the market at a 20-year period and did not go down by half. It was practically equal. Okay? Now, this exercise, well, if it's practically equal, why do it? First of all, if it's equal, timing's possible. Can we agree on that? So that's one part. Second, well, if timing works, are there better ways to time the market? And guess what? Shh, don't tell anyone. But trading after a down gap, a gap downward, is a lot better than doing it on an upward gap. So the timing mechanism, very similar, just one little switch when you buy when they're fearful. And not only do you match the market, you beat the market, or you beat buy and hold. So you can do something and do better. Timing is not only possible, it can do better than just standing still. And that's why I get so angry when people say you can't time the market, because it appears the research shows that it can. Okay? Latest updates, you can go to my new website, scottwelshstrategies.com. Love to have feedback on that. There's the email, there's the website, and so on and so forth. All right, that's all for this week. Please email with any questions. Love to have that feedback. And we'll be back next time with more fun things to talk about. Bye for now.